Ladies and gentlemen, thank you for joining me. This video will be about the balance sheet. The balance sheet is one of the key fundamental financial reports. The SEC requires every publicly traded company to publish a balance sheet, an income statement, and a statement of cash flows. These three financial statements provide investors the information they need to assess the financial condition of their investments or potential investments. The balance sheet is a snapshot in time displaying the company's assets, liabilities, and shareholders' equity, and this is also known as net worth. Other reports, such as the income statement and cash flow statement, reveal financial effects that do occur over time, a month, a quarter, or a year, for example. The balance sheet, in contrast, is a snapshot of financial condition at one moment in time. The balance sheet, as the name implies, shows the balance of the company's assets or the financial means of the company and its obligations combined with its shareholder equity, which is made up of the shareholders' investments and the earnings that have been retained by the company. You could think of it as a formula. Liabilities plus shareholders' equity equals assets. Now, perhaps a more logical formula might read, shareholders' equity equals the assets minus the liabilities. In other words, the value of the company to the shareholder is the company's assets, what it owns, minus its liabilities, what it owes. A company's liabilities and shareholders' equity are the source of a company's assets, which comprise the means that the company uses to operate the company. The balance sheet categorizes the assets into current assets and non-current assets. Current assets are those that have a lifespan of 1 year or less. These are the assets that can be converted relatively easily into cash. These current assets are cash and equivalents, accounts receivable, which are short-term obligations owed to the company, such as customers' credit, etc., and on-hand inventory. Inventory at a manufacturing company consists to raw materials, while inventory carried by a retail company are the goods it has purchased for resale. Non-current assets are those that cannot be easily converted into cash within 1 year, and/or have a lifespan beyond 1 year. Examples of non-current assets include machinery, office machines, buildings, and land. Other examples include intangible assets, such as goodwill and patents. While intangible, they are valuable assets to the company, such as the inherent value of a well-known and trusted brand name. Non-current assets are reduced by depreciation, which represents the cost of the asset over its lifespan. The balance sheet also lists the financial obligations the company owes to its creditors, and like the assets, these are categorized into current and long-term. Current liabilities are those owed within 1 year, such as short-term borrowings, accounts payable, and other obligations that are due and payable within 1 year, including near-term payables on long-term loan borrowing. Long-term liabilities are debt obligations that fall due beyond 1 year from the date of that balance sheet. These include mortgages on land and buildings and other long-term debt obligations. Shareholders' equity initially is the amount invested into the business by founders and other shareholders. As time passes, this is increased through additional shareholder investment and retained earnings from operations. Retained earnings are profits that the company decides to reinvest into the business. Thus, they are transferred from the income statement to the balance sheet as shareholders' equity. A balance sheet displays the company's assets, liabilities, and shareholders' equity broken down as we have just discussed. These will be shown in balance. That is, the total assets will equal the total liabilities plus the shareholders' equity. This is the formula that we just outlined. Let's look at a real balance sheet. Here's the balance sheet of the Apple Computer Corporation as of September 28, 2012, compared with September 23, 2011. Apple Incorporated's balance sheet is broken down into two areas. Assets are shown at the top, and liabilities and shareholders' equity are shown below. The balance sheet is in balance. The assets equal the sum of the liabilities and the shareholders' equity. The last line shows net tangible assets, and this is often referred to as net asset value or book value. It is calculated as the total assets minus intangible assets, such as goodwill, patents, and trademarks, less total liabilities and the par value of preferred stock, if any. Some investor analysts like to divide the net tangible asset value by the number of shares of stock. This gives them the book value per share, which they can then compare with the current share price. Most investors and analysts use a series of ratios to analyze the balance sheet to gain insight into the financial condition of the company. The balance sheet gives insight into two key areas: liquidity and solvency. Liquidity is the company's ability to meet its short-term obligations. Solvency is a measure of the company's ability to continue its operations over a longer time period. Two of the most widely used ratios are the current ratio, which is a liquidity ratio, and the debt-to-equity ratio, a solvency measure. The current ratio is used to test a company's liquidity. It is calculated by dividing current assets by current liabilities. This is a measure of how well the company can meet its obligations and how the obligations are leveraged. Thus, it can give investors an idea of financial stability. Most analysts like to see a ratio of 1 or higher. The debt-to-equity ratio provides insight into a company's solvency and long-term financial health. It is another leverage-related ratio. It compares total liabilities to shareholders' equity. Thus, it gives some insight into the commitment of suppliers and lenders compared with the commitment of shareholder investors. It is calculated by dividing total liabilities by shareholders' equity. It provides a quick look at a company's leveraged position and how management is utilizing leverage. Obviously, large, successful companies can tolerate a larger degree of leverage than can a smaller enterprise. You should calculate this ratio among other companies in the same industry group because different industries vary widely in how they finance their operations. Some industries primarily use debt, and others rely more on equity financing. We've reviewed a lot of material in this video, from what the balance sheet is, how it's organized and constructed, to how to begin to analyze it. The balance sheet has a lot of information to provide to investors, as does its companions, the income and the cash flow statements. Remember that the balance sheet is a report of assets, liabilities, and shareholders' equity as a single point in time. It shows investors what the company owns, its assets, and what it owes, liabilities. We encourage you to watch this video a couple times, taking notes, then go to Yahoo Finance, look up a balance sheet on a company that interests you, and test your familiarity and understanding of the balance sheet. After getting some hands-on experience, come back and view the video again. This will strengthen your learning and confidence in reading balance sheets.